There is a structural rhythm in global finance that repeats roughly every 80 years, not because of superstition, not because of fate, because of compounding. In 1944, the global monetary system reset. The British pound lost dominance. The US dollar became the center of global finance. 80 years later, in 2025, the structure created in 1944 is reaching saturation. This is not a prediction. It is arithmetic, and arithmetic compounds. At Bretton Woods, the dollar became the anchor of the world. Why? Because the United States held the majority of global gold reserves, because it produced half the world's industrial output, because it had the strongest military on Earth. The dollar was convertible into gold. Other currencies were pegged to the dollar. The system worked because it was backed by production. From 1945 to 1970, the United States ran trade surpluses. Debt remained manageable. Productivity growth was strong. Confidence matched capacity. That is early cycle behavior. In 1971, the United States suspended gold convertibility. The dollar became fiat. This was not collapse. It was flexibility. But flexibility removed discipline. From that moment forward, debt could expand without metal constraint. Manufacturing declined as a share of GDP. Finance expanded. Trade deficits became structural. America transitioned from exporting goods to exporting dollars. This is mid-cycle transformation. Privilege replaced discipline. And leverage began compounding. The numbers today: federal debt now exceeds $34 trillion. Debt to GDP above 120%. Total non-financial U.S. debt above 300% of GDP. Interest payments approaching $1 trillion annually. According to IMF and BIS data, global debt exceeds 330% of global GDP. Debt compounds. GDP grows linearly. When compounding outpaces production long enough, the system becomes interest sensitive. Small rate changes produce large fiscal pressure. That is late cycle behavior. Look backward. Britain rose after 1815. Financial saturation emerged by the late 19th century. 2 world wars exposed the fragility. By 1944, the pound ceded dominance. Now look at the dollar. 1944, system established. 1971, discipline removed. 2008, first structural liquidity crisis. 2020, massive monetary expansion. 2025, debt saturation visible. We are 81 years from Bretton Woods. The system is not collapsing, it is aging. Late-stage systems share patterns: persistent trade deficits, persistent fiscal deficits, asset inflation outpacing wage growth, financial dominance over industrial production, rising interest burden, gradual reserve diversification. According to IMF COFER data, the dollar's share of global reserves declined from roughly 71% in 2000 to around 58% today. Still dominant, but declining. Central banks purchased over 1,000 metric tons of gold in both 2022 and 2023. That is the highest level since the 1960s. Gold is neutral. Neutral assets rise in late cycles. Cycles do not end because of invasion. They end because of leverage. When interest payments grow faster than tax revenue, fiscal space shrinks. When fiscal space shrinks, political friction rises. When political friction rises, adaptation slows. Debt reduces optionality. Optionality determines resilience. For decades, the dollar had no credible alternative. That condition is changing. China now represents nearly 1/5 of global GDP. In purchasing power terms, it is the largest economy in the world. China is the largest trading partner for over 120 countries. Trade scale creates settlement influence. China launched CIPS, the cross-border interbank payment system. Over 1,400 institutions are now connected. It does not replace SWIFT, but it reduces dependency. Yuan settlement in global trade has increased steadily. Energy exporters are increasingly open to non-dollar settlement. This does not dethrone the dollar. It builds parallel rails. Parallel rails reduce exclusivity. Exclusivity sustains privilege. The sanctions accelerant. Assume debt grows at 5%. GDP grows at 2 to 3%. Interest rates stabilize at 4 to 5%. The debt ratio increases. Interest expense accelerates. By Congressional Budget Office projections, net interest will become one of the largest federal expenditures within the decade. When interest rivals defense spending, late-cycle compression is visible, not collapse. Compression. Can the cycle be extended? Only one variable can extend dominance: sustained productivity growth exceeding leverage growth, technological innovation, industrial reshoring, energy abundance, AI-driven efficiency. Possible, but difficult at scale when leverage is high and political consensus is fragmented. Historically, late-cycle systems struggle to implement deep structural reform, because reform requires discipline, and privilege erodes discipline. Reserve systems rarely collapse overnight. They erode. The British pound did not vanish, it shrank. The dollar is unlikely to disappear, but it may transition from monopoly to pillar within a multipolar system. Borrowing costs normalize higher. Reserve share gradually declines. Global finance becomes less centralized. This is how cycles reset. Gradually, then suddenly. The only escape. Only one structural variable can extend dominance. Productivity growth must exceed leverage growth. Technological acceleration, industrial reinvestment, energy expansion, supply chain rebalancing. Possible, but historically rare at late stage. Privilege erodes discipline. Discipline sustains cycles. The 80-year cycle is not mystical. It is generational turnover, plus institutional saturation, plus compounding leverage. The system built in 1944 was designed for a surplus industrial superpower. The United States today is leveraged, financialized, and debt-saturated. Still dominant, but saturated. The dollar is not collapsing, it is transitioning. Arithmetic never negotiates. The question is not whether change happens. The question is whether the transition is gradual or abrupt. 80 years after Bretton Woods, the structure is mature, and mature systems either reform or compress. The math is tightening, and 2025 sits at the edge of that tightening.